Most people hear the word foundation and picture a gala, a ribbon cutting, someone handing a large check to a person holding a large check. That is not what this is about. A private foundation is a legal machine. It is one of the most precisely engineered control structures in American tax law, and the families who understand that distinction build things that last 100 years. The families who don't understand it write a check and call it philanthropy. Here's what it actually does. You move money into it. You get a deduction the year you do that. The money is now permanently separated from your personal balance sheet, but you still control how it is deployed. You decide what it funds, who runs it, and in many cases who inherits the seat that makes those decisions. The IRS does not own it. Your creditors do not own it. Estate taxes do not touch it the same way they touch your house or your brokerage account. You gave it away technically and kept the wheel. That mechanism scales. At $1 million, it looks like one thing. At $10 billion, it looks like a sovereign institution with professional staff, lobbyists, investment committees, and more political surface area than most small governments. This video walks 6 levels of that ladder. From the entry point around $1 million all the way to the kind of structure that outlives the person who funded it by 4 or 5 generations. At every rung, the rules change, the costs change, the scrutiny changes, the family politics get harder and stranger, and the consequences of getting it wrong get larger in proportion to the number of zeros involved. Before we climb, there are 5 mechanisms you need to understand cold: the charitable deduction, the 5% minimum payout, excise tax, self-dealing rules, and the difference between a donor-advised fund and an actual private foundation. Know those and the rest of this makes sense. None of this is legal or tax advice. It is a map. What you do with it is your decision. You arrive at the first rung with somewhere between $500,000 and $2 million. Maybe it is a liquidity event, a business sale, an inheritance that landed larger than expected, a concentrated stock position you need to move before year end. The number is real. The question of what to do with it is also real. And this is where most people encounter 2 options that sound similar and operate very differently: a donor-advised fund and a private foundation. Start with the DAF. You open one through Fidelity Charitable, Schwab Charitable, a community foundation, or a similar sponsoring organization. The setup cost is essentially zero. There is no formation document to file with your state, no IRS Form 1023 to submit. You contribute the asset, you take the charitable deduction in the year of the gift, and the money moves into an account that the sponsoring organization legally controls. That last sentence is the one people read too quickly. You advise the fund? You do not own it. The sponsoring organization can, in theory, reject a grant recommendation you make. In practice, they rarely do, as long as you are recommending grants to legitimate 501c3 organizations. But the legal control is not yours. The grants do not carry your name in any formal public record unless you want them to. Giving is fast. You can recommend a grant this afternoon and the check goes out this week. For people who want simplicity, low overhead, and a place to park appreciated assets before deciding where they go, the DAF does that efficiently. Annual fees run roughly 0.6% on the balance, sometimes less at scale. No staff, no board, no 990 filing for you to worry about. The sponsoring organization handles the administration. You handle the vision, loosely defined, a private foundation. At this asset level is a different machine with different costs and different power. Formation runs $5,000 to $15,000 in legal fees. The IRS application takes months. You file a Form 990 PF every year, and that document is public. Your grants, your investment returns, the salaries of anyone you pay, all of it visible to anyone who looks. At $1 million in assets, the 5% minimum distribution rule requires you to grant out roughly $50,000 per year. That sounds straightforward until you account for the excise tax on investment income, currently 1.39%, and the administrative costs of running the entity, which can consume $10,000 to $20,000 annually in accounting and legal fees alone at this size. The math gets tight quickly, but what you gain is control that the DAF does not offer. You can fund organizations that are not 501c3s with the right compliance steps. You can make grants internationally. You can hire family members in legitimate roles. You can structure the governance so that your children eventually sit on the board. The foundation becomes a legal entity with your name on it, a public record of what it funds, and a governance structure that you design. Here is the tax mechanics plainly stated. The year you contribute $1 million in appreciated stock, you deduct the fair market value. You do not pay capital gains on the appreciation. The asset is out of your estate. For income tax purposes, you gave it away. For purposes of influence over where it flows, you largely did not. That gap is the entire point of the structure. The failure modes at this level are specific. People promise impact they cannot deliver at $50,000 a year in grants. They fund causes loosely adjacent to their business interests without understanding the self-dealing rules, which are not forgiving. They allow family members to receive indirect benefits and call it governance. Or they create a foundation with a mission so broad it means nothing, and spend the next decade unable to explain to anyone, including themselves, what they are actually funding. Low scrutiny is real at this level. The IRS is not watching $1 million foundation closely. That is not a feature. That is an invitation to drift without consequence until the consequence arrives. At $10 million, the structure changes character. The numbers are larger, but that is not the primary shift. The primary shift is that the foundation stops being a tax tool and starts being a family institution. Those are not the same thing. They do not behave the same way. The 5% minimum distribution rule now requires $500,000 at the door every year. That is a real grant-making operation. You need a process for evaluating requests, a calendar for board meetings, a set of criteria someone can actually apply. The excise tax on net investment income runs 1.39% on returns, roughly $20,000 to $35,000 annually, depending on how the portfolio performs. Add a mandatory audit, required at this asset level in most states. Add legal fees, accounting, investment management, and a part-time administrator. Realistic annual overhead lands between $80,000 and $130,000. The foundation does not run itself. It runs because someone is running it, and that someone is now a role, not just a gesture. Governance becomes the product. You seat a board, maybe it is you, a spouse, a sibling, and an outside independent director. Everyone has a title. Everyone has standing. A family institution exists, and now every family member with proximity to it has opinions about what it should do and who should lead it. A cousin who is not included asks why. A sibling who is included disagrees about the mission. A child who is named program officer before they were ready makes a grant that embarrasses the family publicly. These are not hypothetical failure modes. They are documented patterns in foundations at exactly this size. The self-dealing rules become urgent here because the lifestyle and the philanthropy begin to blur at $10 million. The family travels to a conference the foundation sponsored. The foundation rents office space from a building the founder owns. A family member receives compensation structured around board service rather than actual work performed. Each of these is a potential excise tax trigger, and in serious cases, a disqualification event. The IRS defines self-dealing specifically. Intentions do not modify the definition. What the family gains is something that cannot be priced on a spreadsheet. Control without ownership. The $10 million is no longer in the estate. It is no longer personally taxable. But the family directs every dollar. They set the agenda, they choose the grantees. They decide what the institution stands for and what it refuses. The name on the letterhead is the family name. That is a form of permanent presence in a community that outlasts any individual. The failure mode at this level is not the IRS. The failure mode is the second generation, which did not choose this and did not build it and now must govern it together. That meeting eventually always comes. At $50 million, the math shifts first. 5% of $50 million is $2.5 million required out the door every single year. That is not a grant-making program. That is a grant-making department. The excise tax on net investment income at 1.39% on a portfolio returning somewhere between 6 and 8% annually runs $40,000 to $55,000 per year before you have paid a single salary or filed a single form. Add a mandatory audit, investment management fees, legal retainer, accounting, and compliance infrastructure. Realistic annual overhead lands between $350,000 and $600,000. The foundation does not absorb that cost from the outside. It absorbs it from the inside, from the mission. This is also the level where the structure makes a choice it cannot easily reverse. You can operate as a traditional grant-making foundation, writing checks to organizations doing the work, or you can become an operating foundation, one that runs programs directly, hires employees, owns facilities, delivers services under its own name. The IRS treats them differently. An operating foundation must spend substantially all of its income on its own programs, not grants to others. It qualifies for different deduction rules from donors. It also becomes something a grant-making foundation it never has to be. An employer, a landlord, a service provider, an institution with staff meetings and HR policies, and a building that needs a roof. That transition changes everything about control and scrutiny. When the foundation writes a grant, it evaluates others. When the foundation runs a program, it is the one being evaluated. It hires an executive director, then program officers, then a compliance manager, then administrative staff. Payroll appears, benefits appear. The founder who structured this entire entity around their values and their name now manages people who have their own professional judgment about how those values should be applied. That tension is not theoretical. It is Tuesday afternoon in the conference room. The documentation and governance requirements become non-negotiable at this scale. Restricted grants carry specific expenditure responsibility rules. Every dollar with conditions attached must be tracked to its outcome and reported. The board must meet with regularity and record minutes that would survive scrutiny. Conflicts of interest must be disclosed, managed, and memorialized. The self-dealing rules that were urgent at $10 million become critical here, because the foundation is now a public-facing brand. When the program fails, the family name fails with it. The failure mode's at $50 million specific. Program sprawl, where the foundation launches initiatives faster than it can staff or evaluate them. Founder dominance, where professional staff are hired but overruled and eventually leave. Reputational exposure, where a single headline about compensation, governance, or outcomes lands differently when the institution is the public face of a family's legacy. The foundation is no longer a tool. It is an organization. Organizations develop their own gravity. They do not always pull in the direction you intended. At $250 million, the foundation stops being the whole story. 5% of $250 million is $12.5 million out the door annually. The excise tax on net investment income runs 200,000 to 275,000 per year on a portfolio generating 6 to 8%. Total infrastructure costs, CFO, general counsel, investment committee support staff, audit, compliance, filing, custody fees land realistically between 1.2 million and $2 million per year before a single grant is written. You do not staff this with a director and a part-time bookkeeper. You staff it with an organization. The org chart has layers, it has reporting lines, it has people who have worked at other institutions and have opinions about how this one should be run. This is also the level where a second structure appears beside the foundation. A holding company, a family investment vehicle, a separate LLC or limited partnership that holds operating businesses, real estate, private equity stakes, or co-investment positions. The foundation sits as the long-term anchor, patient, perpetual, tax-exempt. The holding company moves faster, takes positions, executes deals. Together they form something the $10 million and $50 million levels could not support. A capital control architecture. The foundation provides permanence, the holding company provides velocity. That architecture is genuinely powerful. It is also genuinely dangerous. The IRS does not view the foundation and the holding company as separate just because you filed separate paperwork. Self-dealing rules apply to disqualified persons, which includes the founder, family members, and any entity they substantially control. A transaction that looks clean from across a boardroom table, the holding company sells an asset to the foundation at fair market value, becomes an act of self-dealing if the wrong person sits on both sides of it. The excess business holdings rules add another constraint. The foundation and its disqualified persons combined cannot hold more than 35% of a voting interest in any business enterprise. The structure that feels like elegant coordination can become a regulatory violation without a single person intending it. The failure modes here, The documentation discipline required to defend these structures is not optional at this scale. It is the structure. What the $250 million level builds, if it is built correctly, is durable influence across generations. What it builds, if the governance is soft, is a liability that compounds just as reliably as the portfolio. Both outcomes are available. The difference is almost entirely internal. At $1 billion, the structure changes in kind, not just in scale. The model at this level has a name in the literature: Ford, Hershey. The foundation does not merely invest in a business, it controls one. The operating company sits inside the foundation's ownership structure, or beneath it, or beside it in a configuration designed by lawyers who build more per hour than most people earn in a week. The founder's name is on the building. The foundation owns the voting stock. No individual owns anything. That is the point. Control persists without personal ownership, and it persists indefinitely, because the foundation does not die. 5% of $1 billion is $50 million annually. That number is manageable when the portfolio is liquid. It becomes a structural problem when the primary asset is a concentrated business stake that does not trade on any exchange. You cannot distribute 5% of a private company. You can distribute cash generated by that company. If the company has a bad year or chooses not to distribute or is navigating a capital-intensive cycle, the foundation must find liquidity somewhere else or risk falling short of the minimum distribution requirement. The compliance burden alone requires a treasury function, a legal department, a full investment office, and a grants administration team with enough institutional credibility to defend every decision to the IRS, to Congress, and to the press. Annual operating costs at this level are not $2 million. They are closer to $8 to $12 million before the first grant is approved. The excess business holdings rules still apply. The foundation and its disqualified persons combined cannot hold more than 35% of a voting interest in a business enterprise without triggering excise penalties, unless the IRS granted an exemption under very specific historical conditions. Hershey's structure exists because it predates the modern rules. Replicating it today requires navigating a framework that was partly written in response to structures exactly like it. The board composition at this scale is not a governance formality, it is a geopolitical negotiation inside the family. Seats represent factions, represent money. Who controls the foundation controls the operating company. The family dynamics that felt manageable at $10 million become adversarial at $1 billion. If a health-focused foundation controls a food company that sells products inconsistent with its stated mission, that tension does not stay internal. It becomes a headline. It becomes congressional testimony. It becomes an IRS inquiry. The regulatory failure mode is quieter and more dangerous. Self-dealing violations at this scale carry excise taxes, potential loss of exemption, and personal liability for foundation managers who approve the transaction. The structure that produces dynastic control also produces dynastic exposure. Both outcomes are available. The documentation is what separates them. At $1 billion, the documentation is the governance. At $10 billion, the word foundation stops being accurate in any ordinary sense. What you have is a sovereign institution. It has a balance sheet larger than the GDP of some nations. It has a staff count measured in hundreds. It has a legal department, a communications department, a security apparatus, and a compliance function that exists entirely to manage the compliance function. 5% of $10 billion is $500 million every year required. The grants team does not browse applications and write checks. It runs something closer to a development bank. It deploys capital into programs, infrastructure, policy initiatives, and research at a scale that bends entire fields. When a foundation this size shifts its priorities, universities restructure programs. Governments adjust. The direction of entire disciplines moves. The excise tax on net investment income still applies. At this scale, that line item is itself a material number. The endowment-style investing model runs alongside it. A team of internal and external managers handles allocation across asset classes with a time horizon measured not in decades but in perpetuity. The portfolio is not designed to perform for the founder. The founder is already gone or will be. The portfolio is designed to outlast everyone currently alive who has any connection to it. That is the logic of perpetuity, and it is worth sitting with. The foundation does not appear in anyone's estate. It was never owned. It was contributed to, irrevocably, at the moment of the gift. That contribution generated a charitable deduction against income at the time of transfer. The assets left the taxable estate. The influence stayed. Mission documents, governance structures, board composition rules, investment policy statements, program area restrictions, these are the instruments of control, written by a person who is no longer legally the owner of anything inside the walls. The estate planning result is nearly without parallel. The largest transfer of wealth in the family's history generates no estate tax, no gift tax, and no step-up debate. The price is irrevocability and the 5% floor and the self-dealing rules and the scrutiny that follows an institution of this visibility everywhere it goes. That price is real. People pay it because the alternative, transferring $10 billion through a taxable estate, is a different kind of real. The failure modes scale accordingly. Boards faction along family lines, ideology, or internal politics, and the institution becomes paralyzed at $500 million per year of required output. Mission drift does not look like drift, it looks like strategic evolution until someone reads the founding documents and asks publicly why they no longer match the grants list. Legitimacy crises arrive when the foundation's influence on public policy becomes visible enough to attract scrutiny it cannot absorb quietly. Entrenchment happens when the governance structure meant to preserve the founder's intent becomes a mechanism to prevent any correction at all. The foundation at this level is not a tax strategy. It is not a philanthropic vehicle. It is a governance architecture built to carry control across generations without ownership, without estate, and without end. This is not legal or tax advice. Everything described here is educational. Consult qualified legal and tax professionals before making decisions of any kind. The door exists. What you build behind it is a different question entirely.